What is going on, everybody? Welcome to another video. You guys saw the title already. What would I do if I had to start over, and what strategy would I use, and how would I build out my portfolio? So with that being said, let's go on ahead, cue the intro, jump right into this video.
I know I'm fine, but the money
Okay,
makes
guys, so if you guys are just now starting with your portfolios or whatever, your investing part of your career, really, you got a lot of choices out here on what you should do. And I don't think a one answer fixes all or fits all. I think you really have to go based off of your tolerance. So if you don't want to, or maybe you want more income, or maybe you want less income, more growth. Those are kind of things you have to figure out. Me, if I was starting out again at say 18, I think the best foundation, and I've been saying this for so long now, and it's going to continue to stay like this, is buying into good companies that you believe in or that you use on a consistent basis. So I think that's a very, very solid basis for it now. Now, of course, the more you research and the more things you find out, the more you're going to realize, hey, there are companies that are up and coming. There are companies that are growing a lot. You can get into different sectors. Maybe, hey, maybe I need some more income here. Maybe I need some more growth. Maybe I want to be a little bit more riskier. Maybe, for instance, maybe you deposit $100 a week into your investing account. Maybe you start splitting it up 50, 25, 25, and 50 goes into very, very safe, consistent companies. 25 goes into income, 25 goes into growth. I don't think that that's a bad idea whatsoever. That's kind of how I set up my long-term portfolio when I was younger. Especially when it came into, I really, really invested into stocks that I knew, such as Microsoft's, Apple's, just those companies right there, Coca-Cola, and I did fantastic. I outperformed the market, obviously. You're not going to do that every single year, but I believe if you buy good, solid companies that you believe in, you will get there. For instance, right now I'm buying Nike. Now, for somebody that has a new portfolio, I probably wouldn't be looking at Nike. If you're looking at a new portfolio, I'd probably be looking at things like a SPY, or maybe something that is down, like a Coca-Cola right now, where you can get it now at a discount, technically. So it has good fundamentals. You know people are going to continue to buy Coca-Cola and their products. Or maybe I like the stock that I like a lot is right here, is Hood, Robinhood. I own quite a few shares here on this one. I run covered calls on these. It's not as expensive, so maybe you have $5,000 or $4,000. You can sell cash secured puts on these, and you can start running that wheel strategy so not only are you getting that growth, which I think that the Hood will have, or Robinhood will have, but you can also start to get some cash flow as well, which is income. I think you really, really should focus on buying those good, really good companies and then being able to wheel strategy them, because that will create a gigantic compound effect. Literally, I don't take out the money that I get from whether it's a cash secured put or a covered call from selling options. I just take that money and I buy more shares. I buy more equity. I think that should be your whole purpose, because the more you buy in equity, the less you really have to pay in taxes until you sell it for a gain. I do some tax loss harvesting at the end of every single year. Not every single stock you're going to buy is a winner. That's just not how it's going to happen. Now, some years like this year, I had big years with Palantir, Hood, SoFi. Again, the SoFi, again, I think is going to be a game changer. I've been buying this since the 8s. I sold it on a cash. I sold it on a covered call, meaning basically they got assigned those shares, and I had to sell them at that price. And then I also, though, have some more shares up in here in the 16s, but I'm not panicking. I'm still selling covered calls against them, just further out in time, and I'm still cash flowing the stock while I own equity. I don't plan on selling it. So that's how I think I would start. I would get some fundamentally good stocks that I think are going to have some growth, as well as maybe something like a PTY, which is something that I invested into heavily, that was straight income. So again, maybe if you're doing that $100 a week, maybe $25 goes into PTY every single week, gets you some monthly income moving in, and then you start going to some cash secured puts or maybe some calls that you're selling against your stock and things like that. I think you really have to know what your life expectancy, what you're planning on. And I'm not saying like when you're going to die, but the life expectancy of your portfolio before you're going to really start pulling out of it, or maybe you're going to start continuing to dump into. I know some people work at the end of the year and they get big bonuses and get big chunks. I do that. I put large chunks of money back into my portfolios because it's better for me to continue to invest right now, because thankfully I'm not even 30 yet, and I'm going to be able to reap the rewards later because of the amount of cash flow that I have from just good stocks. For instance, Nike. I bought Nike at 75. I'm very, very transparent about this, but I'm not down near as bad as what I would be because I'm running covered calls against this. So I'm mitigating my risk really towards the downside as well. Now, again, some of these different things can be. Now, some of you are going to be like, what about some poor man's covered calls and things like that if we don't have the money? I'm not against a poor man's covered call. I think I would just run a credit spread though. And if you guys don't know what a credit spread is and you're looking at a covered call or a poor man's covered call, I think you guys, if you guys are interested in the poor man's covered call, I think you guys should also look at the probability of a credit spread that's far out of the money and just continue to get a little bit of cash flow that way. I have done the poor man's covered call. I have made large chunks of money off the poor man's covered call with, of course, less money than I need. If I'm going to do a poor man's covered call, though, because I know that this subject is going to come up, I'm going to do it. I don't even need this because all my credit spreads are gone now on these. I am doing it on really, really good companies or ETFs that I believe are going up over long term, like the SPY, the S&P 500 ETF. I'm going to go do it on companies like this. Now, what does this look like? I want to go ahead, show you guys what this looks like. And you guys can do this on smaller companies as well. And actually, let's go on ahead and do it on Hood, because I think that this is going to be much cheaper than maybe you don't have $4,000. So let's go to trade options. Let's go to Hood here. And the first thing you're going to do is you're going to buy an option that's basically like a year out or further. So I'm going to go a year out because it's going to give me a lot of time. Now we want to buy a call. Now I want one that's in the money. So I'm going to go over here. And I'm just going to go to like a 27. I don't think, again, you guys can go back and look at these things. A 27 is very, very in the money because it was way down here. So let's go maybe not a 27, let's go like a 30. Yeah, because obviously it gets more and more expensive, so let's go to a 30. Now again, this is going to cost you $1,600. So instead of having to have $4,000, basically got to have $1,600. Now again, what you can do to mitigate this is now you can go and we only want one. Okay, that's fine. Now we can sell a call 30. It's got to be 30 or above further out. We can come back here and go, I'm probably going 40 days out still though. So our strike price was a 30. I'm probably going to go like a 35. Well, I'm probably going to go out of the money actually and say I want to collect 41. So if the stock goes up $2, and you guys are going to see, I can make a max of $400 if this gets assigned. This is a poor man's covered call. You are buying an option that gives you the rights to it out here and then selling cheaper calls that are out of the money coming up. So that is the whole basis of it. And it's pretty simple. Again, your total cost here, your max loss is going to be $1,200. The great thing is say after these 40 days expire, you collected all $365 and it's not above that $41 range, you get to go do that all over again. That is the greatest part about this. And again, you're holding the rights to it. I do like the poor man's covered call, but for a beginner that doesn't have the fundamental of your portfolio down yet, I would not recommend this trade. Again, I'm not a financial advisor or anything like that. I just run my own money, but I like Hood. And for somebody like my fiance that's doing something like this, I would not recommend that to her yet. What I would recommend is saving up enough money on a stock that you love, getting enough shares, and then starting to sell covered calls or selling a put once you've saved up enough money to start selling those premium options against your money. So that's where that whole thing goes. That's how I would start my portfolio. I hope this helps somebody else out there, and thank you guys for watching.